Welcome to Barchart's weekly webinars designed to help you, the trader investor, better understand a variety of trading ideas and concepts, as well as the pages and tools Barchart provides to help you make a more informed investment decision. Today's subject, short strangles. So have you ever noticed shortly after an earnings report or an end of an earnings cycle that the volatility of stocks or stocks options falls dramatically? Well, this is commonly referred to as the volatility crush. The demand for options that are related to a particular stock or stocks drops after earnings, right? You might have heard something like buy the rumor, right? Pre-earnings, sell the news, post-earnings. Well, the short strangle strategy looks to take advantage of this phenomenon. Hello, I'm John Rowland, Barchart's head of trading education, and today we're going to take a look at the short strangle strategy, and we're going to look at its components, its aspects, its risks, and hopefully I'll give you some food for thought to help you decide if this option strategy is right for you. Today with me, as always, is my partner and our moderator, Jean Baker. Hello, Jean.
Hello, John. How are you?
I'm doing fine, and yourself?
I'm good. So John and I have a little a bet going about how many times between the two of us we're going to mangle short strangles.
Yeah,
Short strangles.
Yeah, in the past, you've always kidded me about my senior moments when it comes to credit strategies. How I always invert or inadvertently change the calls to puts or bears to bulls, or so I guarantee, Gene, that I'll accidentally swap straddles for strangles. So I'm going to need you to keep me in line.
I'll try.
Actually, I have a yellow post-it on my monitor that says strangle, 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 right?
Yeah. Well, we'll get it right today.
Hopefully. Okay, just our disclaimer, just remember that today's session is for educational purposes only, and that all trading has a form of risk, options trading especially, and that options trading is not for every trader. And certainly this particular strategy does have a greater risk. At Barchart, we always recommend that you consult with a professional financial advisor so that you understand your financial condition and if you have the ability to bear that risk. And also remember that past performance is not indicative of future results. All right, short straddle. There it is, right out of the box. Short strangle strategy. Okay, I know we've just been kidding around, Gene, about straddles and strangles, but both short strategies have similar goals. They look for steady or falling volatility and little price movement. Now, there are pluses and minuses when it comes to the two strategies. Strangles being that there is less premiums, and that's because the strikes that we're going to choose are out of the money and therefore less value when we compare them to the strikes we use for a straddle, which benefit from being closer to current price. Now, the benefit of a strangle is a larger price movement in the underlying has to occur before we will have a loss. So there's a benefit to the strangle. All right, so it's a short-term income strategy, right, where we're going to look for time decay and little price movement. The setup is we're going to sell a call above current price and sell a put below current price, out of the money. And our strategy itself, in theory, has unlimited risk, and our maximum profit is only limited to the credit that we're going to receive. Now, here's where the strategy gets that term strangled, right? So what we're going to do is we're going to set up, and we want price, in order for this strategy to be successful, we want price to stay in between our two strikes, right? Again, think about this. We're strangling price. We want price to consolidate in between our two strike values, strangling it. If you think about a straddle, well, think about like sitting on a fence where the strike price is the fence. All right, so break even, maximum gain and loss. So break even occurs if price at or before expiration is at or below one of our strike prices by the amount of the total premium that we collected. Our maximum gain will be achieved if price is inside of those two strikes and we are held this through expiration. And then the two strikes, or the two options that we're going to sell, will expire worthless, right? So the only way we can achieve maximum gain is we have to hold this strategy through expiration. Now, our maximum loss is unlimited in theory, right? If price rises above our break-even level, then our loss could be unlimited. But I don't know any stock that trades at infinity, right? But just realize that if you do have a large price movement above your break-even, you could sustain a substantial loss. On the downside, you know, again, in theory, unlimited, but it would be limited to the value of the stock going to zero, right? So the point being here is that substantial losses can be incurred when price breaks outside of the range of our Strangles break-even values. That's what I really want you to take away from this, all right? Risks. So what's some of the risks that we need to be aware of? Well, expiration risk, right? It's varied and it's very complicated, especially when price is right near one of our strikes at expiration. So this is why we'll look to exit this trade before expiration, especially if we're nearing one of our strikes, right? So think about this for a moment. We're going to exit before expiration, so therefore, we're never going to achieve maximum profit, right? So we're going to be out before expiration. Volatility is a large component of this strategy, right? This is kind of our monkey wrench, right? If volatility rises substantially during the time of our strangle trade, that's going to have an adverse effect on it, right? So volatility could rise, believe it or not, even if the stock price doesn't change dramatically. So what are some other risks that we need to be aware of? Well, there's something called assignment risks. And assignment can happen at any time, but usually it'll happen for calls just before our stock goes ex-dividend, and for puts if that strike becomes in the money. Now, a call assessment here assignment could occur if price of the underlying is higher than the call strike price, and then the trader would be assigned or obligated to sell the stock at that strike price. Now, if you own those shares, they'd have those shares called away from you. If you don't own the shares, then you would be forced to buy to cover, and normally that would be at a higher market price, right? So the assumption here is that we're going to have ownership of stock, right? We're trying to learn how to create income from a stock that is not performing, right? That's the first part. But we don't have to have ownership in order to employ this strategy. So my spin is that we're going to own the stock, and this is how we're going to create income on this stock that is not performing. But we'll also look at something called margin in a moment that will make ownership, will help with the cost or the capital risk. A put assignment, again, if we think about it the other way, price now is below our strike, and then we would be assigned or obligated to buy the stock, right? Now, this would require us to purchase those shares. Now, it's not necessarily a bad thing. If that strike price is at a level where I believe there's value in that stock, then that's okay, right? But here's what we need to think about is that there is a capital risk involved. In other words, I'm going to have to put up capital to buy that stock, right? So let me pause here for a moment, right? So some of you might have recognized now as I've gone through this scenario that a short strangle is actually two naked strategies, right? And this makes this particular option strategy margin heavy. In other words, a lot of capital outlay in order to put this trade on. Now, typically the formula is that the capital requirement of the short call, and that's because the call price will be higher than the put price, in other words, the value of the stock. And so if we already own the stock, we could use that stock as collateral, and therefore then your broker would probably only charge you the margin that is based on the put requirement, right? So that would lower our capital outlay if we own that stock. All right, what is the impact on our Greeks? So delta neutral, right? So if we set our trade up in the beginning, well, we're going to try to get our deltas of our two strikes as close as to each other, so delta neutral to start with, then small price movements are not going to have a lot of effect on our strategy. But if we get a dramatic price movement, that might force our hand to make some adjustments. And we'll look at that a little bit later. Theta, right? Time decay. Time is our ally, right? Vega, volatility, again, if our implied volatility rises, that's going to have a negative effect. If our implied volatility is steady or falls, that's going to be positive. And then gamma, well, this relates back to our delta issues, and if price moves substantially or quickly, right? So short strangle success considerations, some things that I want you to kind of think about when we put this trade on. So the first one is we're going to look for candidates that have high implied volatility ranks. Now I put here 50%, all right? So here's where each trader's risk tolerance comes into play. So if we consider this strategy based on the earnings release, right, then a more experienced or risk tolerant trader would set this up before earnings, right? And maybe that might imply a higher implied volatility, right? A more conservative trader might wait after the earnings is released and then set the trade, right? Now, there might implied volatility might be falling or be less, right? So that means less risk and smaller profit. But what we're talking about here is that this direct correlation between implied volatility and premiums, right? I kind of call that the meat on the bone, right? The higher the ranking, the higher our implied volatility, the more meat on the bone. And what we're really talking about here is the more premium that I take in when I set this strategy up, the wider the spread of our Strangles break even, right? The farther the price is away, and that would give us a greater probability that we'll have a successful trade. The second consideration, I'm going to only look for a dollar credit, right? Now, that's because of this added risk of this particular strategy to the unexpected price movement. We want to get paid. Yeah, but you still don't want to get paid in nickels, right? We want to get paid in dollars. We're going to set our strike deltas in a range between 10 and 20%. Again, there's a trade-off here, right? The lower the delta, the lower the premium, right? But the less likely the probability of that strike finishing in the money. Now, remember, if a delta of 20 or less means that there's only 1 in 5 chance that that strike will finish in the money, or better yet, 4 out of 5 that it won't. Patience, right? Relax, grasshopper. Even a price movement towards one of our strikes is not a bad thing. As long as we're inside of our strike range, inside of our break-even range, we'll be fine. Relax, don't worry. And finally, here we're revisiting that fact that we're not going to go for maximum profit. In other words, hold this trade through expiration. I kind of call these kind of trades my Steve Miller trades. I've talked about this before in some of our credit options strategies. Steve Miller band, right? I'm going to take this trade and take the money and run, right? Once I get a small percentage, I'm going to be more likely to take this trade off. Now, as a risk management on this one, why I put up 30 to 50% here of the credit we received, think about it like this. If I'm up 30% of the credit that I receive, in other words, let's say, for instance, I took in $7.50, and now that Strangle is only worth $5, I've taken in a third of that credit. And if I'm looking at my price on a chart and it's still inside of the middle of that range, then I'm okay with that. But if price starts to move outside of, let's say, a recent high or a recent low or support or resistance levels that are inside of my range of my strikes, then that might be a signal for me to take that trade off or set up out a set of rules of risk to help me decide when I'm going to exit that trade. Now, if I'm up 50%, I've taken in 50% of that credit. And again, if price is not moving, I'm probably not going to do anything. But if price down moves above one of these areas of support and resistance, right, or I start giving back some of that credit that I took in, then that might be onus enough for me to take this trade off. All right, so here is the short strangle setup. So let me run through the mechanics of this, and then we'll dive into the details of this particular trade. All right, so in this particular, and this is Coinbase, and this one popped up last week, we're going to short the 280 call, and we're going to receive a credit of $3.15. Notice the delta at that time was 16.89. Now, at the same time, we're also going to short or sell the 200 put and receive a credit. Now, there is a typo here. The credit that I set this trade up was $4.10, not $4.15. The delta was 17.29. So what is our total credit received? Well, it's the 315 plus the 410, or $7.25. So what we do from there is we add the credit to our call strike, and that will be our break even to the upside. 280 plus 725 gives us a break even of 287.25. We're going to subtract the credit received from the put strike. $200 minus 7.25 gives us 192.75. So as long as this stock's price stays in between 287.25 and 192.75, this trade will be successful. Okay. Now, there is kind of a bonus to this analysis here. We're going to be very mechanical about how we set this trade up. It's going to be based on our delta. It's going to be based on how much credit we're going to take in. Again, our volatilities, right? That's how we're going to find the candidates. Now, I do kind of like to look for stocks that are in the kind of a sideways trading action, which we can see this one is doing that. But the other thing we can start thinking about in terms of a bonus is if I can find some nice resistance or support that is between my current price and my strike price, that just gives me more confidence that even if price starts to move, it's going to probably react to these areas of resistance or these areas of support. Now, remember, we talked about that risk management aspect. If I've captured 30 or 50% of the credit and now price is getting above this area of resistance or below this area of support, I'm not going to wait to see if it's going to challenge my strike. I'm going to exit that trade, right? Because now I'm seeing price go. Again, this is a philosophy of trading and a risk management style. But if I've captured 30% and now price is starting to move again, then that might be onus enough for me to exit that trade. Okay, so let's do this. All right, so I'm in Barchart. I'm under the options section, and I've clicked on the short strangle page. And let's see what our results are right now. And right now, the page is generating 221 different possible short strangle candidates. Now we'll go a little bit deeper into this and how we can narrow this down. But let's just walk through what we have available to us as far as information. So first of all, here's our symbol. Just remember, if you go on the plus sign here, you do get the opportunity to see kind of some Reader's Digest information, price history, a little chart, headlines, financial information, Barchart's opinion, technical analysis, key statistics, and so on. What is the price, the current price of this particular stock? What is the expiration date of the options that we're going to look at? And then our strikes are leg 1 and leg 2. Now, notice that leg 1 will always be the call, and leg 2 will always be the put. And then what is our delta, right? And in this case, the leg 1 strike here, delta is 11. And what is our delta for our put? 14.53. So again, at this point here, what we want to do is we want to find those that are below sub 20, but we also want to try to find these two deltas as close to possible as we can get. Now, if I was going to give you a guideline, I would say like between 1.5 to 0.5%, which would be ideal, right? When you start getting outside of 3, 4, or 5%, then your strategy already has a bias to one way or the other. So we want to really try to get to delta neutral, right? Within, let's say, 0.5 to 1.5%. And so in this example here, you can see it's almost 3.5. So that might not be a good candidate for us in terms of setting it up as delta neutral. Now down here, I see a 15 versus a 16. That is closer. That's inside of 1%. That might be a better candidate in terms of getting closer to delta neutral. What is our net credit? How much credit are we going to take in from selling those two strikes? What is that percentage of that price of the credit we're going to take in as it relates to the stock? Again, in this one, I can't really give you a threshold. I don't want to discourage you or, say, hey, let's wait for a higher percentage. But again, think about that meat on the bone, right? And I might want to start thinking about maybe above 1%, or maybe start looking at 2 to 3% if I can find those. There's going to be a trade-off again, depending on how much credit we take in stock price. Our implied volatility average. Now, this takes into consideration both puts and calls that are both above and below. It just kind of gives you an average of what your implied volatility is. What is our break even, our downside break even, our minus? We're going to take our credit minus our put strike, or our upside, our break even to the upside, our credit plus our call strike. And then probability, right? And so what probability tells us here is the chance that price is going to stay inside of break even. And so in this one here, it's telling us that there's a 99% probability that price is going to stay inside this range of these two strikes. So again, what we might do on this one is we want to start looking for these higher probabilities, but you can notice that the higher the probability, the lower the credit you're going to receive. So there is this give and take we have to be aware of. We might take less probability, right? Maybe like 80 or 85% in order to gain more credit, right? So there's a trade-off there, all right? So we have this is on the main page. When we go inside of here, we can also look at dividends and earnings. And again, these are factors that we have to take in considerations that could disrupt our trade. The ex-dividend date, right? So, if that ex-dividend date is inside of my expiration date, then I know that dividends are going to have an effect on the strategy at some point. If it's outside of my expiration date, then I don't need to worry about it. In this example here, our ex-dividend is outside of our expiration, so we wouldn't have to worry about that dividend issue. Earnings, right? And so you have an earnings date. Now, if it says now NA, it doesn't mean this company doesn't have earnings. It just means they haven't set the earnings date for their next earnings cycle. Now, typically, companies will announce earnings dates about 6 weeks in advance. Now, this is a short-term strategy. Most of us are going to be setting this up inside of probably a month's time. So as long as it says NA, you're probably going to be okay. Now, again, that's no guarantee, but just be aware of that. Now, there are some that do give our earnings here. You can see this one is earnings is on the 4th and the expiration is on the 6th. So this, if we took this strategy, we sold before the earnings on the anticipation of juicy premiums, right? Then we're going to look for that volatility crush after the earnings release. But again, we're probably going to exit this trade before the expiration of that that options contract. What are our strikes? Again, we have that from the other one. What is our deltas? Again, trying to get close to delta neutral, and our credits. Then we also have something called the filter view, which is kind of a nice feature. And there are some default filters that we can look at. Days to expiration, again, our probability, and then our volume and open interest on these particular options. So one of the things that I've talked about in all option strategy is this idea that institutional traders tend to trade more monthly options than they do weekly options. So one of the cool things about this one is you can see those options that have larger open interest is kind of hinting to you that those are the monthly ones, and also that you're going to have a lot more participants, right? A lot more institutional traders than you would see, for instance, in weeklies. Now, I'm not saying not to trade weeklies, right? And I know there's a lot of traders who do this strategy using weeklies. I'm just saying that there are some benefits trading monthlies, and those benefits are greater open interest, greater volume, and usually what you will see is better premiums. In other words, those credits that we're going to try to capture. All right. So let's see what we want to do next. Okay. So we talked about some market considerations for setting up this strategy. Right now we have 219 candidates, so that's a lot of candidates to try to dig through. So we're going to make 2 small adjustments to our short strangle screener. I'm going to come in here where it says set filters. And what did we say the first thing we want to look for? We wanted to look for high IV rank, right? So I'm going to go IV rank. And I do have some options here. I can look at IV rank over the year, 6 months, 3 months, 1 month, or 5 days. If I'm trading in a weekly, I'm probably going to look at the 5-day implied volatility. But since I like monthlies, I'm going to look at 1 month. I'm going to add that. And I said above 50. Again, you could lower this, right? Just realize that the lower you make the implied volatility ranking, the lower the meat, or the smaller amount of meat on your bone, so to speak, right? So I do that, and what does it knock this down to? Let's see. It's like Jeopardy. Okay, 52. All right, great. All right, so we've now lowered it down to 52. You could just go through these as well. But what's the other criteria that we said that we were going to think about? We want to we want to get paid dollars and not nickels. So I'm going to come back in here and I'm going to just write net credit. I'm going to add that. And I want to take in at least $1. And I lower that. Now I've turned 221 down to 16 different scenarios. Now, if we look at this, it really only looks like about 5 candidates, right? So I'd have to go through and look at my deltas, my time to expiration, look at if there's a conflict of dividends or something to that effect. Now, what I also might do here is, now this is kind of weird because I was looking at this as early this morning, and this is live trading. One of the ones I was looking at didn't pop back up. But one of the things we can do is we can just kind of go into our flip charts and look to see what the chart is doing. And again, here's kind of one of those stocks that's kind of been floating inside of a range of price. Looks like it's been floating between like $55 and $70. Now it is near this recent area of resistance, but let's just check and see what the strikes are on this one. And we'll do a firm. And it was $80 versus $60. So if we look at that on our chart, here's our 80, right? And here's our 60. Now, I'd like the upside strike. The downside strike, I probably would want to be, below here, maybe closer to 50. Now, that means I could tailor this to my own personal specs, right? So that's one of the things you can do in terms of looking at different candidates. Now, ADM, I do see here. Now, if we look at AMD, right? Is this a candidate we want to set a strangle on? No, not really, right? It's parabolic. It's been running away. Probably a big gamma squeeze going on here. Yeah, there's probably a high volatility, a lot of juicy premiums, but there's also a lot of risk for this type of strategy. I do notice that coin popped back up, which is kind of cool. That it's back in there. And let's just check out what coin is saying, 225, 250. Remember, ours was 200 and 280. All right. All right. So the other thing that I want to do before I move away from here is, once I have this filter set up, I can save this filter, right? And then what I can do is also I can save that filter, or I can have that results sent to me at the end of the day report. I could type in how I saved that, say short strangle, make some notes, maybe write in those 2 filters that I put in there. And then I can have that report sent to me. Now, Gene, you're gonna have to help me out here again. I believe premium members have the access to the midday report, where all regular subscribers just get the end of the day. Is that correct?
Well, actually, the option screeners that we're looking at today are part of the Barchart Premium subscription, and so you wouldn't really be able to save a short strangle screener unless you were a Barchart Premier user. And yes, Premier users can send these at midday and at end of day. So that is a Premier feature.
Okay, cool. I appreciate that. I always get confused which ones are applicable to our premium members. Now, again, on this one, I think I would probably send this to me as a midday report, because then it becomes more actionable, right? I'm going to see this as these trades are being set up. Now, it doesn't mean that I need to be on top of the market. I could still get this at the end of the day, and I still could do my due diligence, especially if we're thinking about time, right? We do have time on this one, but I think I would probably, my personal preference would probably be a midday report. All right, so let's do this. Let's go back to our Coinbase. Okay, and let me just kind of set this back in so you guys can see this. All right. All right. Okay, so let's look at this trade as I set it up last week. Now, the red line here that goes through the middle of our chart is the 27th. That's when I set this trade up. On that day, the IV rank was 52, again, above 50. Our historical volatility was 58. Our implied volatility was closer to 63. I kind of like to see my implied above my historical, and I'm hoping for that mean reversion back to the historical. Again, falling volatility. Again, remember we took in $7.25. And if we look at this trade right now, over the last 5 or 6 days, yeah, price has been falling. Now today the price is back up a little bit, but it's still right in the middle of our range. So my guess is that the market is going to reward me because I correctly predicted that price is going nowhere fast. All right, so let's go and look and see what's going on with this trade right now. So what I've done is I've gone into the options section under the implied volatility in Greeks page, right? Now, what I do is I can do that through this tab section here, or I can do, if I collapse that so I can see more information, I can find it through this tab selection as well. All right, so let me fix my glasses here. Oh, updating for us, cool. And I did the monthly, you know how I feel about those, monthly, the August monthly, and I'm using all strikes because we have some strikes that are pretty far away. Now, let's look what's going on. Well, historical, kind of right in the same value, maybe a little bit less. Our implied volatility has ticked up a little bit today. Yesterday it was right at 62. The day before it was at 62. So it has ticked up a little bit. So that will have a small adverse effect to our results. All right, so let's go down and first let's look at our 280 call. And we can see our 280 call is a 324, and our delta is 17, still right where it was 6 days ago. Now, just talking about that small bump in volatility, here's price history. I just want to show you how volatility can impact this strategy, even in the smallest. You can see that, you know, yesterday this call was only worth $1.80, and today it's already back up to $3. So just a 3 or 4% movement in volatility has really kind of juiced up this strike. But again, we can see that, you know, when price was falling, that this call value was falling as well. All right. So around 324 for that. And let's look at our put. Here we are on our puts. Here's our $200 put, right? And our last trade was 265. Our theoretical is 250. Our delta is 12. Again, our delta has fallen, which is a good thing. And the other thing we can start looking at is our theta. Now let's just scroll this up. You can see up here, this is our theta. And our theta on this one is losing 24 cents. All things being equal, this strike will lose 24 cents by tomorrow. Right now, volatility has ticked up a little bit. And as far as our call was concerned, right, again, you know, looks like it's our theta is around 30 cents, right? So if I can hang on for one more day, and as long as price stays right where it is, you know, the value of this strangle should fall about 50 cents, right? All things being equal. All right. So let's see, $3.24, and what was the other price? It was $2 or so. Yeah, 250. So yeah, it's ticked up a lot. It was right around $5 this morning. Now it's around $5.75, $5.85. So it has ticked up a bit today on that in volatility. All right. So I've gotten close to a third. I'm still inside of that range. I got time on my side. I know that this is going to decay with every day from about 40 to 50 cents every day. So as long as price stays in this little tight little range in here, you know, I'll probably hold on to this until the end of the week. All right. So let's talk about what could happen if price does move, right? And I always like to think of it in extremes. Let's pretend we put this trade on and overnight, boom, market moves, has a big price movement. It busts out above one of these support or resistance areas, or it starts challenging one of our strikes. So first of all, you know, again, as long as the trade is working, right, I'm not going to panic. I'm not going to panic here, right? Even though today I'm giving back a little bit, this trade is still working. And in my trade plan, I want to have rules to avoid over adjustments, right? I don't want to over adjust. I don't want to tinker with it too much, right? So my personal trade plan rule is one and done. I get one adjustment and that's it. If the market is adverse to me or I start losing money, I'm out. That's it. I don't go and try to make multiple adjustments, all right? So let's talk about three different potential scenarios. Let's talk about scenario one first. Okay, let's say my delta increases. One of the sides increases. Now, right now, they're both stuck in between, but let's pretend that price was falling and this delta here, this put delta starts rising as price moves closer to that strike deltas, right? When price is right on a strike delta, our deltas get close to 50, right? So let's say it doubles, right? Or gets above 30, right? So this is going to increase my net delta, right? The difference between the two strikes. So what I want to do is I'm going to roll my untested strike, the strike that prices are moving away from. And what I'm going to try to do is I'm going to try to reduce my net delta by at least a third or a half if I can do that, right? So again, in theory here, let's pretend that our stock price is going down. So let me do this. And let me just draw a little ray here. Let's pretend our price is going down, right? What I'm going to do now is I'm going to roll my call strike down closer to current price. Now, again, I might set it based on a support or resistance, in this case, a resistance, and I want to try to lower that net delta again. I want to try to get that as close as I can. Again, maybe I might not be able to get net delta neutral, but I could probably reduce my exposure. Now, I'm not going to do this as a leg, right? I'm going to do this as a vertical credit spread. I'm going to buy back that cheap option, the one that is lost value, and then I'm going to sell the strike that's closer to current price. I'm not going to touch the strike price that price is gravitating towards, right? Now, what this will do is this new short strike is going to add more credit to this trade, which will allow me to move out my break-even price by amount of how much credit, the difference between what I had to buy the one and the one that I sold, I'm going to take in. That's going to allow me to move this out. Now, it also does bring down my break-even from the top up here, but again, that would be just the total credit that we've had received added to this new strike price. All right, so what's the risk here though, right? What's the risk? The risk is that price, right, pops back up, right, and gets back above this call strike. right? So that is one of the risks that we're going to have to worry about if my new strike becomes in the money. All right, what's my second scenario? So let's pretend now price has gotten really close to my strike price, right? Again, I'm going to roll the untested side, but this time what I'm going to do is I'm going to change this from a strangle to a straddle. In other words, I'm going to sell the same strike price of, in this case, my put, so that both my put and my call will have the same strike price. Now, again, this is going to increase my break even from the point of uh, this strike price. But what is my end game here, right? So this adjustment, we really kind of want price to come right to the strike and stop. We don't want it to move anymore, right? Again, this might also go back to some technical analysis about area of support or resistance. In this case, do we find significant support? Do we find trend lines? Do we find other things that give us onus that say, hey, maybe price is not going to fall much more, right? But turning our strangle into a straddle. And then finally, what happens if I wake up and boom, my price is now between my strike and my break even, right? So, I mean, personally, at this point, I probably would exit the trade, but there is something we can do to manage this, or at least try to repair this. And what we're going to do is we're going to go inverted, which means we're going to go upside down. So what we're going to do here is we're going to roll our call, in this case, below our put if prices are falling. If prices are rallying, we're going to roll the put above the call strike, right? Now, here's the importance about an inverted adjustment. You need to make sure the credit that you receive is greater than the width that you set your strikes, right? So let's pretend my inversion, I did an inversion of, let's say, $5, something like that, $95, right? Then what I want to make sure that the credit I've taken in is greater than $5. If I did my inversion at $10, I want to make sure that the credit that I've taken in is greater than $10. And then what we want, again, our end game here is we want price to stay in between those two calls, that call and that put. What'll happen is both of those will finish in the money, but you only have to worry about the intrinsic value of them, and that would be the total intrinsic value would be the width of this new setup, and that anything that you collected above that width would be profit. Or a lot of times what you'll discover when you do this kind of inversion is you're just looking to break even or maybe have a very small loss. So I would consider the inversion or inverted process really the adjustment of last results, okay? Again, you know, for every adjustment we make, it brings along a new set of risks, right? So, I mean, let's be honest with ourselves, right? We're not in the business of losing money, right? We need to learn how to realize that we're wrong. So, you know, when in doubt, get out, right? Or Steve Miller it, right? Take the money and run. You're up 30% and all of a sudden it starts going all against you. You know, if you only make 15% or 20%, so be it. Take the trade off, live to fight another day. And what we don't want to do is turn a small loser into a big loser, okay? All right, so that's kind of what I wanted to talk to you guys about Strangles. I do see some questions popping up here. And so let me go through them. Gene, is there any questions that are kind of common as I'm reading through these?
Well, I've passed through a number of questions to you. I think maybe before you leave the chart that you're on, Aaron was asking a question about whether you are rolling the strike down in the same expiration period when you're making
Yes,
these.
yeah, you can. Yeah, you can do. That's what we want to do. We'll talk about calendar rolls at another time. We can do that, but that's a little bit more complicated. But yes, you could do that. Yes.
Okay. Well, John,
Uh,
I'm going to give you a moment to review the questions that I've sent through to you. And while you do that, let me talk a little bit about Barchart Premier. The options screeners that John has been going through with you are part of the Barchart Premier subscription. And if you are not a Premier user, we really suggest that you try it out. There is a free 30-day trial available to anybody, and you'll be able to actually play around with all these different filters that he's talking about, look at the data. You will have to go through and, as John has been showing you, analyze each situation to see whether the trade is going to be good for you or not. But if you're not a premium member, go ahead and try it out. You have nothing to lose.
Okay, cool. So I do see some good questions here. So Ron asks, what is the trade-off between a short strangle and an iron condor? Again, Ron, if we're putting in an iron condor, we're actually buying another, really kind of buying a long straddle, right? Excuse me, a long strangle. So that will cut into our credit received. Now the advantage is that we don't have to worry about making adjustments because that's kind of our insurance to the upside, to the downside. So that would be the difference in there. We're going to do iron condors probably in the fourth quarter sometime. So Roberto asks, is there any books that are available? So Roberto, there's a lot of books out there. There's a lot of information on YouTube. Again, our own website here in our tools under the webinars, we've talked about different strategies, but there is a Bible of options that a lot of traders use, and it's called the Options as a Strategic Investment. And I think the author's name is Lawrence McMillan. Don't ask me to spell that. I'm pretty sure it's MC and not MAC, but Lawrence McMillan, options as such, and that is kind of like the Bible of options trading. All right, let's see what else we have here. Ron asks again, what's the difference between, you mentioned 1 month, any more insight would be great. Well, Ron, what we're really talking about in a strangle situation is that theta decay, right? And so the theory of options says that around 40 days, theta starts to accelerate. And inside of 20 days, it really accelerates almost exponentially. So ideally, we probably want to set this trade up when the premiums are a little bit richer, right around that 40-day window or just inside that 40-day window, and then take the trade off as we get inside that 20-day window. And again, remember, we're not taking this all the way to expiration, but there are a lot of traders who set these types of trades up on weeklies on the Monday for the Friday expiration. Now, again, these folks are probably taking in a lot less credit than what we went through here, right? And again, I talked about this in other webinars about picking up nickels and quarters in front of a steamroller. And yes, you can do this very successfully in a long period of time, but you just need one of these trades to blow up in your face, and a month full of nickels turns into a year's loss, right? So it's important for you to understand that concept between probability and the reward versus risk that you're going to take. But good question there on that one, Ron. So Ted asks, what about legging out of a trade? So Ted, I don't want to be crude here, but the only person or things that should be legging would be dogs when they go out into the yard, if you know what I mean. Typically, when we go to try to leg, I'm not saying that you can't leg, but usually what happens, we end up screwing it up, right? We end up using emotion instead of being very diligent about our risk management. I would rather roll, and I'm assuming you're asking about rolling when we're making those adjustments. Now, if you're asking me, hey, price has moved, let's say price has gone down, and I've gotten towards that lower strike, and the upper strike is worthless or getting very, very cheap, taking that off and then letting taking my chances on the downside. Yeah, well, the next thing you know, price, could go in the total opposite direction or something like that. So, legging that, I'm not a big fan of leggings in that scenario. All right. So how are we doing on time? Okay, I got time for a couple more questions. So Andy asks, is it better to create a bearish call put limited risk? So I'm not sure what you mean, Andy, if you want to rewrite that question. All right. Ted wants to know what is the delta differences. He sees negatives and positive deltas on the screens. So the screener will show you the results of price movement as in terms of delta, right? So if I'm long and price goes up, I'm going to have a positive delta. If I'm long option or something and price goes down, I'm going to have a negative delta. So that's why you'll see that. Now, typically what you see is that calls have a positive delta and puts have a negative delta. But because we're doing a short strangle, we're actually the opposite. So a falling value would have a negative delta to a call. In other words, the delta would get smaller and smaller because we're moving farther and farther away from that strike. Ted, we did a webinar on Greeks and how to interpret this. So look in there, and I think it's the Understanding Greeks webinar, and I'm going to show you that in a second where we can find that information. All right. Okay. And then Jeff asked, do I prefer days to expiration? Again, Jeff, I think it's about that theta. I'm going to kind of look to set this up inside of 40, just inside of 40 days, or, maybe about a month ago. And then as I get inside that, a week or 10 days to go, if I haven't really captured some premium or something, I'm probably out of this trade. But if the trade is working, I'll hold on to it. Again, normally I'm out of this, 5 days or 3 days prior to expiration. Okay. All right. So that does take us to close to the top of the hour. I want to thank everyone for coming. I hope you enjoyed today's session. So I know Jean is going to want me to show you this.
Yes, I do.
So under our resources, our tools, our free webinars, and today's webinar is up there. At the end of the day, if you attended today's session or signed up for it, you're going to get a link to this recording. And then next week, we're going to do a deeper look into candlestick price theory. Now, about 2 weeks ago, we did one that was called was Understanding Candlesticks Charts. Yeah, here it is.
Exactly, yes.
There it is right there. So again, you don't need to watch this for next week's webinar, but I would encourage you to watch it. It's going to give you a little bit of base information on what we're going to build upon on this. But next week's webinar is we're really going to supercharge candlesticks. And what we're going to look at is that there is this kind of theory that markets are what we call fractal or repeat themselves, and that we can use higher time frame candlestick patterns to help us look for the same candlestick patterns at lower time frames to give us higher probability trades. It's a really cool top-down analysis approach to candlesticks, and I think you guys are really going to enjoy it. This is really kind of an insight about how I trade and what kind of setups that I'm looking for. So that's for next week. Anything else, Jean, that I forgot?
No, I just want to congratulate you, John. You only misstated short strangle once. So congratulations. Yeah, job well done.
What was the probability on that? I don't know.
Very, very well done.
Thank you. Well, so I want to be safe out there, folks. I want to wish you the best of health and the good of all trading.
Thank you, everybody, for being with Barchart.com. We appreciate you being here and hope to see you again next week. Thanks. Bye.